Hey, what's up, stock compounders? Brad here. So Howard Marks, one of the best investors around, put out a memo just about a month ago called Sea Change. Okay, for those of you who aren't familiar with Howard Marks, he wrote a book, The Most Important Thing, which he went into about 19 most important things in investing. Fantastic book. It's really a collection of his memos over the years. And Warren Buffett, this is one of the memos he looks forward to most every quarter. Okay, and that is high praise, obviously, from one of the greatest investors of all time. So there is a lot to unpack in this memo. I want to kind of give a high level of what the sea change is. Just the third sea change that Howard Marks has seen in the last 50 years. And then we can kind of dig in a little bit to different pieces of the memo. So what is a sea change? A complete transformation, a radical change of direction. Okay, that's what Howard Marks thinks we are on the verge of in the markets today. What is the first sea change that Howard Marks experienced? So the first one was a shift from buying good things, right? A focus on investment grade securities, to buying things well, which means you can buy riskier assets, maybe not here, failing to possess the characteristics of a desirable investment, according to Moody's. You can buy things like that, given the price is low enough to compensate you for the risk you're taking. Okay, so that was the big sea change shift 53 years ago. And now, of course, we just factor in the risk of different investments to come up with, all right, what is a price that I can pay for this investment and still do well? Howard at the end here says, in 1978, I started investing in these securities, right? These non-investment grade bonds. The bonds of perhaps America's riskiest public companies, and I was making money steadily and safely. So that was the first sea change. The second sea change is interest rates going from 22% in the early 80s down to 2.5% recently. Okay, so that's a 20% drop in interest rates over 4 decades. Now, Buffett said something like, interest rates are gravity to asset prices. Okay, you really can't understate the magnitude of impact when you have a change in interest rates that's that dramatic. And I just want to show you guys a quick example. I tweeted this out today. So Howard Marks was borrowing at 22.25% in 1980 and 2.25% 4 decades later. So, how does that impact asset values? Okay. Using Aswath Damodaran's valuation for Facebook last year, here's how substituting those interest rates for the discount rate impacts value, right? A business generates cash flows into the future. To arrive at a value for a business, you've got to discount all of those future cash flows back to today, and that's the value of the business. Now, when you change that discount rate by this much, you get the difference between a value of $125 per share at a very high interest rate and $516 per share at 2.25% discount rate. Okay, so massive change just from that change in interest rates that we've seen over the last 40 years. Bear in mind, with Facebook, the cash flows tend to be further out. It's a high growth kind of tech company. So this is going to be more of an impact for a company like this than it would be for a mature business. But something I found a very instructive exercise going through that. So Howard Marks, this isn't in the memo, but more recently he was on a podcast, Behind the Memo, okay, where he kind of talked through his memo a little bit. And he used an analogy in that talk. It's not in the memo itself. But he says, not everyone understands the magnitude of this impact in the change of interest rates. If you put a frog in a pan of hot water, it will jump out, right? The frog knows it's a dangerous environment. It feels that it's hot and it jumps out. Now, if you put it in a pan of cool water and you turn on the burner, it'll get gradually hotter and the frog won't know to jump out. Okay, so because it's such a gradual change. This happened gradually over decades with the interest rate falling. And I think that not everybody is fully conscious of the magnitude of the impact. Okay, so Howard Marks is comparing investors in the market through this period of declining interest rates as frogs in a pan of water that got the heat turned on, and it's slowly creeping up to the point where you can't really tell that it's dangerous. But that's kind of what Howard is pointing at here. So that's the second sea change, the dramatic drop in interest rates. The third sea change, we went from an active and stimulative Fed, okay, a lot of optimism in the system. Today, I'm going to show you guys, we're going to jump down to this chart here, because this really captures how he sees the sea change, how the environment looks to me, okay? So this 2009 to 2021, this section really includes kind of 1980 to 2008 as well. There was that one shock, but you can think of this as the last 40 years and minus a few crashes in there. And then today, how different it is. Fed behavior. Howard talks about how the Fed rate hikes of 75 basis points consecutively. That's the most aggressive Howard has ever seen, the Fed increase rates. So really you're going from FOMO, this incredible period of the last 40 years, fear of missing out really dominated the investor mentality, to fear of loss. Okay, that's really the big shift if I had to encapsulate it. So Fed behavior, inflation, we're at a 40-year high. Economic outlook, everybody thinks a recession is pretty likely in the next year or two. Likelihood of distress rising, right? This is that shift from FOMO, fear of missing out, to fear of losing money. The mood, you can see that, buyers, eager, hesitant. Prospective returns, lowest ever, okay? And today, more than ample, okay? Howard's really talking about this from the credit side, as he primarily invests in high-yield bonds. And definitely we see some yields increasing pretty quickly over there. So those are kind of the three sea changes that Howard Marks lays out here. So let's see what else I wanted to pick out for you guys. We already talked about that, the first sea change. Second sea change, declining interest rate environment that prevailed for 4 decades. I'd be surprised if 40 years of declining interest rates didn't play the greatest role of all in terms of, the wealth creation over that time. Even though there were contributions, gains in technology, productivity, management techniques, the benefits of globalization. There were other factors, but Howard's pretty sold on interest rates being far and away the biggest factor. He talks about the effects of declining interest rates, how it really stimulates these different asset classes. Seems to me a significant portion of all the money investors made over this period resulted from the tailwind generated by the massive drop in interest rates. Now, Howard would include himself in this. Okay? Howard is a billionaire. I think he's got a net worth of like $2 billion. He's been incredibly lucky to play the markets, during this time. And he points that out as well. So the recent experience, talks about the global financial crisis and the Fed's response to the global financial crisis, how dramatic the effects were, and how it really kept the markets comfortable, risk on. The paltry yields on safe investments drove investors to buy riskier assets, right? So that speaks to, in a low interest rate environment, a lot of these funds, these pension funds, they got to hit targets, right? The only way to hit targets when the safe investments are yielding so little is shifting to riskier assets. So this kind of brings in some of Howard's bias here. And I think it's important to keep this in mind. For what felt like eons, from October 2012 to February 2020, my standard presentation was titled Investing in a Low Return World, because that's what our circumstances were, right? From the perspective of Oak Tree Capital, it was a low return world, right? Bonds, just weren't yielding very attractive returns. Hard to achieve good returns dependably and safely in a low return world. So we've seen that already. Asset owner's market and a borrower's market. Frustrating period for lenders and bargain hunters. Of course, Howard, being a bargain hunter, felt like a long slog. So, talks about how Oak Tree, having spent the years 2009 to 2019 in the wilderness, given our focus on credit and heavy emphasis on value investing and risk control. Returns on most of our closed-end funds, although fine, were moderate by our standards. Right, long slog. So it's been tough for Oak Tree. It's been tough for their investment approach. I'm sure Howard would love a sea change about now, right? He would love some more opportunity in the markets for the types of investments that Oak Tree goes after. So, definitely, his glasses are filtered with that lens. But that doesn't mean there's not a ton of value in how Howard is thinking about all of this. Clearly there is, but you always want to look for biases when you're getting into the mind of someone, kind of seeing how they see. How do they want to see? And he says later, all of these predictions that he's making about how things might unfold, Oak Tree isn't betting on that forecast. They're not putting money on this. This is really kind of a thought exercise for Howard. So keep that in mind as well. Don't read through this and think, Howard's really smart. What does he say here that can give me an indication of what types of investments to go after? That's the wrong way to look at it. This is really just to educate us as investors, to try to piece the puzzle together. And just to be aware of where the risks might be. Investor sentiment often careens from flawless to hopeless as events that were previously viewed as benign come to be interpreted as catastrophic. So, investors, we can be a pretty flighty bunch. Emotions really tend to run high when people start feeling the losses. and that can just really catapult the losses further. Okay, so we get back here to how the sea change looks to Howard. The outlook. Inflation and interest rates are highly likely to remain the dominant considerations influencing the investment environment for the next several years. No one can predict inflation. It seems likely to remain higher than what we became used to after the global financial crisis. So here's what Howard thinks is coming. The underlying causes of today's inflation will probably abate as reliefs on savings are spent and as supply catches up with demand. Globalization is slowing or reversing. If this trend continues, we will lose its significant deflationary influence. Since consumer durables prices declined by 40% over the years, thanks to less expensive imports, cheaper labor overseas. I estimate this took 0.6% per year off the rate of inflation. Before declaring victory on inflation, the Fed will need to be convinced not only that inflation has settled near the 2% target, but also that inflationary psychology has been extinguished. Okay? Fed will likely want to see a positive real Fed funds rate at present it's minus 2.2%. So you guys can kind of read through this. These are the reasons I believe that the base interest rate over the next several years is more likely to average 2 to 4%, not far from where we are now, than 0 to 2%. Highly stimulative rates are not in the cards for the next several years, barring a serious recession. But I assure you, Oaktree isn't going to bet money on that belief. There is a forecast I'm confident of. Interest rates aren't about to decline by another 2,000 basis points like they did over the last 40 years. So again, the real crux of the sea change right there. As I've written many times, we never know where we're going, but we ought to know where we are. The bottom line for me is that in many ways, conditions at this moment are overwhelmingly different from and mostly less favorable than those of the post-global financial crisis climate described above. These changes may be long-lasting or they may wear off over time, but in my view, we are unlikely to quickly see the same optimism and ease that marked the post-global financial crisis period. Importantly, if you grant that the environment is and may continue to be very different from what it was over the last 13 years and most of the last 40 years, it should follow that the investment strategies that worked best over those periods may not be the ones that outperform in the years ahead. That's the sea change I'm talking about. Okay. So again, guys, really worthwhile reading through this whole thing. Just to get a sense for where we are, right? And how all of these things fit together. Just to be a more informed, thoughtful investor. Again, he did a kind of mini podcast, 20 minutes long, just kind of talking through some of the big topics in this memo. Check that out. And I think that's all I wanted to cover, guys. Big shout out again to Howard Marks. And if you haven't read his book, The Most Important Thing, check that out as well. I think it's required reading for any intelligent investor. So I will leave you guys there. Thanks a lot for watching, and I'll see you in the next one.